All right, we're recording. Hi everyone. My name is Ben,
I'm Alice.
and we're doing the Wells Fargo scandal, which broke in 2016 and occurred from 2011 to 2016. We're going to start off with an overview. Our first thing that Alice is going to talk about is the summary of what happened, sort of the general stroke of the timeline between the beginning on 2011 all the way up until the present day. Then we're going to get into the background on Wells Fargo, who they are as a company, how they're viewed in the industry. Then we're going to get into cross-selling. What is it and how does it relate to this topic? Then we're going to get into some of the key players. There's a few of those, company executives, as well as some former executives. Then we're going to a timeline of the way this all broke down from the first story that broke in 2013 all the way to the congressional hearing that happened last week. Then we're going to get into some of the penalties that happened through the Consumer Federal Protection Bureau or for the Justice Department and some of the case settlements. After that, we're going to see if sort of anything has changed since the 2016 case broke and the aftermath for some of the employees and investors in the company. Finally, we're going to end with some conclusion and discussion questions.
The Wells Fargo fraudulent case arose on September 8, 2016. The company was accused by the Consumer Financial Protection Bureau, the Office of the Comptroller of the Currency, and the Los Angeles City Attorney. The organizations claim that Wells Fargo, between 2011 and mid-2016, it created additional fraudulent bank accounts for pre-existing customers. They were signing up over 2 million customers for new credit cards and deposit accounts that they were unaware of. Wells Fargo was fired 185 million, and the bank in response fired 5,300 employees that were involved. The fraud allegedly resulted from the company's sale program created by the CEO.
All right. So founded in 1852, Wells Fargo is the fourth largest bank in the world. It's also the fourth largest bank in terms of assets in the US. It's managed to avoid a lot of the missteps that happened with a lot of the other large banks in the 2008 financial crisis. Primarily, they avoided a lot of the credit default swaps that a lot of the other banks were doing that were seen as very risky. And they kept their reputation as a conservative bank that prioritized its long-term relationships rather than its sort of short-term profit chasing that happened in 2008. A lot of analysts and other banks were amazed by its ability to generate sort of huge profits, even as like other banks were stumbling through because of its ability to cross-sell. Having been marketing itself for many years as like the lender of choice because of how much it stressed long-term relationships, a lot of people were stunned and surprised that a company of such stature would go through and break its trust over such a small percentage of its revenue.
This was done due to the cross-selling expectations led by senior executives of the company. Cross-selling refers to selling different product or service to an existing customer. Basically, the average number of bank accounts a person needs is about 2 to 3 accounts, where Wells Fargo was setting that number between 6 to 8. This puts a huge burden on employees to make sure that they meet the sales quota. By executives throwing in incentives such as compensation, this makes for an even more pressured workload. This is John Sump. He's one of the key player. He is an American business executive and retail banker. He is the former chairman and chief executive officer of Wells Fargo, one of the big four banks of the United States. Another key player is Carrie Tolstedt. She is a retired American banking executive and former head of the community banking division at Wells Fargo, from which she retired in 2016, right before the company account fraud scandal came to light.
Something to add about this is Carrie is in charge of all the branches in the business, as well as all of the community tellers that the case sort of focuses on. At Wells Fargo, they added a significant number of accounts to people that didn't realize it, and Carrie was the person who was supposed to be in charge of sort of the oversight and accountability of these branch managers and lenders. Without that accountability, they were able to sort of do what they wanted, however they wanted to reach their goals. And so Carrie, while she doesn't really seem to be a key player, was really the direct oversight to what happened in this process. So this is Richard Kovovich. So he was the chairman of Wells Fargo from 2001 to 2005. He instituted what is known in Wells Fargo as the Great Eight, which, as Alice said earlier, they stressed to get 8 different products. By products, that could be a mortgage, it could be an auto loan, it could be a checking account, a credit card, just a regular savings account, insurance. They had a lot of different vehicles to get people to get into their company and to put more money into their company. And he stated that instead of the 1 or 2 products that many banks really cared to get and spend money to recruit to get more customers, if you just sold the different products from the same company to your current customers, you can generate a lot of profit through that as well. So he instituted what is known as the Great Eight, and that emphasized having 8 products per person. They were, at the time of the scandal, right around 6 products, but it's definitely up from the 3 products that they were having in 2001 when he joined the company. He's known as the father of cross-selling. Like I said earlier, he really emphasized sort of not only adding new customers, but upselling the customers that they currently had. Another big point is he started the chain of employee-based accountability in the company. In many companies, they have upper level managers or they have auditors who sort of keep track of the accounts and how much money is going in and out of them and how they're being created. He was primarily focusing on having the employee do it all themselves and having employees be the only line of defense for any sort of fraud to occur in the company. This led later, when he retired in 2005, to keep this mentality so that when John Stump took over, he kept it, and it led to tellers at will adding accounts for people without them realizing it.
These are the numbers from 2011 to mid 2016. The 2.6 million in fees accounted for only 0.02% of revenue for the company.
Yeah, and so with that, they made $23 billion in 2015 alone. And so having such a small percentage of income come from these fees, it's almost foolish to have such a fraudulent act of assigning accounts to customers that didn't realize it, only to generate $2 million in fees off of those 1.5 million accounts. And as we get into later with some of our discussion questions, we're going to talk about that. So this is a timeline, starting with the first article breaking of the scandal. The LA Times reported that relentless pressure to sell sort of battered employee morale, and that led to ethical breaches. This occurred in December 21st, 2013. It has been reported that this practice had been going on from 2011, but there are other reports that state that it had been occurring since Richard was in charge of the company in 2001. Following that, the company said that they were going to look into it, and they fired some employees. And that was sort of the end of it until September 8th, 2016, when the fake account scandal broke wide open due to reports from the Consumer Financial Protection Bureau that stated that all 2 million accounts were fake. There was only a few accounts in the beginning in 2013 that were reported, but the 2 million was what was reported in 2016. About a week later, the bank announced that it would be ending its controversial employee sales gold program. 7 days later, John Stumpf appeared in front of the Senate Banking Committee to sort of account for what was going on in the company, and so that Congress could get a better look at the corrupt practices that are happening at the branch level. He sort of pleaded that he didn't have much control over what happened in the front of his office. This was a not wise decision because it made it look like he was putting blame on the front office employees when since 2013 there's been reports of this pressure to sell, but he sort of took a step back and said it's not my fault, it's not the executive's fault, it's all these individual employees' faults. And this can be sort of traced back to that 2001 mentality of employee accountability. It took a hands-off approach from executives and allowed them to say that they didn't know what was going on. A week later, the bank independent directors announced that John Stumpf would forego $41 million worth of promised compensation, as well as his usual salary, as they launched an independent investigation into what was happening in the company. So after that point, in October 16th, so about 2 weeks after that, Stumpf was sort of forced to resign as CEO. He still was paid. He still had accumulated a retirement policy that was worth about $22 million. So he was still pretty fine, even though he forfeited a lot of his earnings from the company. And throughout the next year, there were many different lawsuits from the Consumer Financial Protection Bureau, from the Justice Department. There were some class action lawsuits that were sort of scattered, but they started to organize and get into larger dollar amounts by 2018. And these were some of the biggest ones. In April of 2018, there was a $1 billion lawsuit settled over charging people for auto insurance without them knowing. This was one of their cross-selling features, was auto insurance. And so that had its own separate lawsuit along with like mortgages and other sorts of things. In February 2020, there was a $3 billion settlement over criminal and civil action cases, according to the Justice Department. So that was just last month that they settled on that, and it was a class action over all 2 million accounts that were opened. In March of 2020, so this month, actually last week, the House Financial Services Committee is still having hearings related to their investigation. One of the main leads of that was Senator Elizabeth Warren when this thing started in 2017, and is still ongoing through the House. So even though the Senate Financial Committee already met with him in 2017, the House Financial Services Committee is still having their hearings related to the investigation.
So what went wrong? John Stumpf's mantra to employees was often 8 is great. 8 is great, meaning is that to get 8 Wells Fargo products into the hands of each customer, but this directive proved burdensome for bank employees as they struggled to meet demanding quotas and satisfy even more demanding customers. Penalties and fines. The bank has since paid billions in fines to various government agencies as well as lawsuits and settlements. Wells Fargo former chief executive John Stump was fined 17.5 million, and that is the largest individual fine in the history of the bank's main federal regulator. Five others, including a former head of Wells Fargo retail banking operations, were also charged by the regulator. They have been forced to pay over 6 billion as a company in fines and lawsuits over the past 4 years. Wells Fargo is required to pay estimated of 2.5 million to customers and hire an independent consultant to review its procedures.
So some other repercussions for some other stakeholders in this. Since 2011, 5,300 employees have been fired for creating phony accounts. Since the company has taken an employee accountability approach to it, a lot of these people were sort of scapegoated as the problems for the company. But many of them have not been able to find other professional jobs because Wells Fargo wrote in their professional records, because many of them had FINRA records that sort of trace their careers from company to company if they transfer banks. And they wrote in their professional record that they had short-term funded bank accounts or created these phony accounts. And so other banks are not going to hire them because nobody wants to be seen as hiring someone who just was sort of fired for being corrupt at another bank. And since a lot about banking is trust, because you're sort of trusting them to hold your money appropriately, no one's going to hire these other employees. There have been a lot of reports that a lot of them did not actually open these bank accounts, and some of them were clean. And so some of these people, many of whom who are just regular tellers, were being falsely accused by managers who are trying to avoid some of this blame. In addition, there is now like consistent oversight over Wells Fargo from committees such as the House Oversight Committee and the Senate Oversight Committee. And so they have to consistently report back to those sorts of bureaus to prove that they're stopping these sorts of pressure schemes in the future and that they've changed their employee culture. In addition, a lot of Wells Fargo's shareholders took a big hit. In the initial aftermath, at least, the share price fell from about $50 to about $45, which was about a 10% decrease over 2 weeks, which is a pretty big hit. They also had a lot of negative returns in terms of many people were pulling their accounts from the company or canceling credit cards as such because they've lost this sort of trust that they've built up with their clients. In those 5 years, they were charging people fees for accounts that they didn't open. And many of these accounts were sort of defaulting and negatively affecting customers without them understanding like how that was the case. For example, when they would put car insurance on a auto loan, a customer assumes that they're going to be charged only a certain amount for the loan, so that's what they are assuming they're going to pay for it. But by tacking on the fees and the cost of the auto insurance, while it helped Wells Fargo increase their numbers, it hurt the consumer by not having enough money to pay for the accounts. And so they put roughly auto insurance on over 1 million different auto loans. 250,000 of those loans went into default and 25,000 cars were repossessed, which just shows the large impact of how terribly this hurt the typical Wells Fargo customer. Other examples, while we saw that they only made 2.6 million in fees, that's 2.6 million that never should have happened. And so the negative impact for the regular customer was that while many weren't sort of impacted, it was only roughly 26 to $40 a person over the course of the entire sort of scheme, it was an uncalled for amount. So that, in any case, those hurt consumers the most. Here we put a picture of sort of Wells Fargo stock price over the last 5 or so years. Right here in this first circle is the scandal that I showed earlier in the bigger picture. But what's been surprising is that people have had a sort of a short-term view to these sorts of scandals that have been happening, because even after this initial drop up until almost 2017, it comes right back up. And then this one right here was one of the fines, and it goes down and it comes up. And then this was one of the $1 billion fine. So it went back down again because it comes back in the news and people are starting to realize it. And then people sort of lose track of it and it comes right back up. And so it really brings the question of whether or not it was worth it for Wells Fargo in terms of these things, because it hasn't really negatively impacted their share price as much as a lot of other schemes have done for other companies in the past. In the current day, Wells Fargo is trying to change their image from what happened in 2016. Sort of the mantra of we are a better brand. We've changed for the better because of it, and they're trying to say that you should come bank with them because supposedly they've changed. So this is just showing how they're trying to change their image by saying that they're reestablished in 2018. It's sort of them finally coming to terms and admitting their faults and stepping in front of it. People tend to have a better reaction towards people who admit that they're wrong and try to become better, rather than just keep blaming other people for something that probably should have been a corporate oversight to begin with. And by doing so, they've had some positive reviews to their employee satisfaction, but not too much has changed since then. While they have eliminated the technical sales goals that drove the grade 8, they're still being pressured by the corporation and the executives to hit certain goals that are, while not technically sales goals, they are profit goals. And so while the culture has technically changed due to not having to hit these sales numbers and creating these phony accounts, the culture itself hasn't really done much to change that.
So, in conclusion, the best thing Wells Fargo can do is get in front of the issue with the public and their customers. They need everyone to feel as tough as they are taking this due with all seriousness, and believe that their customers are truly the heart of their business. They need to do this by reaching out to their customers and making them feel comfortable to ask any questions that they have.
So these are some discussion questions that we came up with. We're not going to answer them right now. We're just going to wait until class on Friday to bring them up. But here's the first one. What are some suggestions that you could have that could have prevented this scandal from happening in the first place? The second one, if you are a middle manager, would you hold your employees to these goals even though you knew they were unreachable? So what we mean by this is if you were someone who was hearing down from upper level executives that they wanted these unreachable numbers, would you hold your employees to these unreachable numbers, or would you start to push back on and protect your employees? And do you think that's a reasonable response for a manager? The third one, if you were a manager at another bank, would you hire a former Wells Fargo banker, even though that there is this suspicion that a lot of them were creating these phony accounts? And how much responsibility do you place on Wells Fargo as a company and their culture for causing this to happen? The fourth one, do you feel the punishment was sufficient? In total, Wells Fargo has so far been fined roughly $6 billion and forced to pay back a lot of that to consumers. Do you think that this is enough? About 5,300 people have also lost their jobs, including a lot of the major executives that we mentioned earlier. Is this enough, or do you think it should have been even more so? And the fifth one, what was the big picture of the big impact of the scandal, and who was really hurt? Was it really the consumer? Was it the company? Was it America as a whole? And who do you think was really hurt the most? And that's all we have. We have sources. We look forward to hearing your discussion on Friday. Thank you.
Thank you.